So hello, good people. This is your tutor CPA Choi. So today we would like to look at a very common topic in the advanced financial reporting, and it's tested even in the financial reporting. So this is a international. This is from International Accounting Standard 7, so IS7. So that is a preparations and the presentation, or we can say presentation of cash flow statements, presentation of cash flow statements. So the presentation of the cash flow statements. So when we talk about cash flow statements according to International Accounting Standard 7, so we always say that there's various functions of a cash flow statement, or there's various reasons why we do a cash flow statement. Like now, we can do cash flow statements to reconcile the opening cash and the closing cash for an entity. We can do cash flow statements to know the sources of funds and application of funds for an entity. We can do cash flow statements as a requirement of international financial reporting standards. So those are some of the reasons I can mention. So cash flow itself is just a process of renewing and analyzing companies' statements to make a better economic decision. So we analyze the statements of the companies to make a better economic decisions. So which are some of these statements which are analyzed? So we analyze income statements and we do analysis of the statements of financial position. So statements of cash flow, statements of cash flows. So actually the statement of cash flows, so since they are used as methods of analyzing statements, as we say that we analyze income statements and statements of financial positions, so the cash flow statement shows the actual movement of cash for a business enterprise. So it discloses various categories of cash flows. So the basic purpose of the cash flow statement is to provide about the receipts and payments of a business entity. The receipts and payments of a business entity. So, which I've mentioned about various reasons why we do these cash flow statements, or which I can repeat and say that they show the sources of cash in the business. They show the applications of cash. They assist in the reconciling of opening cash and closing. It's a requirement of IFRS. That is it. So these categories of cash flows, we mentioned about cash flow from operating activities, cash flow from investing activities, and the cash flow from financing activities. So when we talk about operating activities, what do we mean? What do we mean that these are cash flows from operating activities? So these are activities that are revenue generating. So which are these revenue generating activities? So they are transactions that are used in the determination of net profit. So e.g. we have cash, sales, payment of salaries, wages, we have purchases, cash received from debtors. So in short, the day-to-day operations. So cash flow from operating activities involves what happens on a daily basis in an entity. So we move to investing. So when we talk about the cash flow from investing activities, we say that these are activities that lead to the change in size and the composition of the non-current assets, e.g. acquisition of plant and machinery, acquisition of investments, investment incomes, proceeds on disposal of plant and machinery, proceeds on disposal of investments. So in general, we say that these activities lead towards to change in size and composition of non-current assets. So generally, it will involve the disposal and acquisition of the assets. So because now when we will be doing this aspect of investing, I will be mentioning about cash received on disposal of assets, cash paid on acquisition of assets. So the last part of the categories of cash flow, we have the aspect of financing activities. So when we talk about financing activities, these are activities that relate to change in size and composition of equity and non-current liabilities. So that is the finances, e.g. proceeds from issue of shares, additional loan debentures, prepayment of loans, interest paid, dividends paid. So what finances an entity generally? What will be financing the entity? So when you are doing the presentation of the cash flow statements, we use two methods. So we can use indirect or direct method. So the only part which will differ in the two methods is only the operating activities, because when presenting a cash flow statement using either of the methods, we always present them based on the three cash flows: the operating, the investing, and financing. But whichever method you will use, that is either direct or indirect, the only area which will differ is the operating activities. So let's go ahead and draw the format for indirect, then we do. So I can start with the indirect, then we finish with direct method. So the format for indirect method, so let's say XYC Limited. So consolidating cash flow statements. So for the year ended a certain period there. So shillings. So we talk about operating activities. We start from profit before tax. So we adjust this profit with non-operating items, the non-cash flow items. So adjustments which are done here. So we adjust with what? Depreciation. We talk about impairment. We talk about amortization. We talk about loss on disposal. So all of these are added because they are expenses. They were deducted to arrive at the profit before tax. So we add back. Then we raise what? Gain on disposal, because this one was added. We raise a share of profit after tax in associate or joint venture. So this was an income to the parent from the associate or joint venture. So we deduct. Then the last thing we are supposed to add here is the finance cost. So that is how you adjust the profit. That is how you adjust the profit before tax. Then after adjusting the profit before tax, we say cash flow before working capital. That is before changes in working capital. Then now changes in working capital. The changes in working capital. So for the changes in working capital, we mentioned about increase or decrease in current assets or current liabilities. So under current assets, we look at inventory, receivable, prepayments. Then under current liabilities, we look at payables and accruals. So here we say increase in current assets, decrease in current assets. So shillings. So remember that for the increase in current assets, it means that there is money out. Decrease in current assets, money in. Increase in current liabilities. Decrease in current liabilities. Decrease in liabilities, you deduct. Because you have paid liabilities, there is money out. Increase, you add. You have acquired liabilities, so there is money in. So up to this point, we have the aspect of cash generated from operations. Cash generated from operations. Then you raise tax paid. After deducting that, you get your cash flow from operating activities. This will be your A. This one will be recorded as A. Then we move to the next part, that is investing. Investing activities. So under investing activities, you talk about things like cash received on disposal of assets, cash paid on acquisition of assets. So we always say that for investing activities, they do what? The cash flow from investing activities, they lead to the change in size and the composition of non-current assets. So that is why I would say, for example, cash received on disposal, cash received on disposal of assets, cash received on disposal of assets, cash paid on acquisition of assets. So this one is deducted. Then we have investment income, which we add. Then maybe remember that under advanced financial reporting, if we disposed a subsidiary, we received money. If we acquired a subsidiary, we paid money. So if it's a disposal, we say cash received on disposal of subsidiary. On disposal of subsidiary, net of cash disposed. So that one you add. So we continue on this side. So if it's a subsidiary which was acquired, you say cash paid to acquire subsidiary, net of cash acquired. Then up to this point, you will be done with investing. So you say cash flow from investing activities. Cash flow from investing activities. So you put on the other column. Then you talk about financing activities. So for the financing activities, you check equity and liabilities, because we said for the financing, it does what? These are activities that lead to the change in size and composition of equity and non-current liabilities. So you focus under the part of equity and liabilities. That is where you focus most. So under equity, you talk about cash received on issue of shares. So if there was shares which were issued, if you redeemed shares, you say cash paid on redemption of shares. On the redemption of shares, you deduct that. You consider if there was dividends paid by parent. Dividends paid by parent to who? Dividend paid to NCI. To NCI. Then after this, I can consider if there is loan repayment. Loan repayment. If there is acquisition of loan, we add. Acquisition of debentures, we add. Then interest paid. In some scenarios, we consider finance cost. If there is no accrued interest for you to do analysis, we consider just finance cost as your interest paid. Then up to that point, we have the cash flow from financing activities. Then you talk about net cash flow. So this one we can put at the end here. So net cash flow, you take the total for operating, the total for investing, I can name B, and this one is C for financing. A plus B plus C. So then you say add cash and cash equivalent brought down. Cash and cash equivalent, balance brought down. So you add to the net cash flow so that you get your cash and cash equivalent, balance carried down. So that's all about the aspect of indirect method. So for the cash and cash equivalent items, it includes cash in hand, cash at bank, short-term investments, and bank overdraft. Let's mention about the direct method. Then from there, on the second part of this video, it's all about the illustrations based on both direct and indirect methods. Based on the direct and indirect method. So the direct method. So for the direct method, we always do the operating activities this way. We start from cash received from customers. Then we talk about cash paid to employees. We deduct that. Then cash paid to suppliers, we deduct so that we get cash generated from operations. So after cash generated from operations, we raise tax paid. So once we raise the tax paid, that is when I will be able to get the cash flow from operating activities. So that is how you do the operating activities for the direct method, because for investing and financing activities, it will just remain the same as that of indirect method. So the only thing I will be able to show you here is all about how you can be able to arrive at the cash received from customers, cash paid to employees, and cash paid to suppliers. So let's compute that. For that, 3 items. So to determine cash received from customers, you prepare this account. You prepare this account. So which account is this? So this is a trade receivables account. The trade receivables account. So you mentioned balance brought down here. Balance carried down here. What can increase this account? Sales, which were made on credit. Credit, debtors balances. Debtors balances. Debtors balances on subsidiary acquired. So if a subsidiary is acquired, those debtors balances it came with will increase this account. What can reduce debtors balances? Discount allowed. So discount allowed. Bad debt written off. So if debtors balances, so debtors balances on disposed subsidiary. On disposed subsidiary, you credit, it will reduce. If the subsidiary was disposed, those debtors balances it was disposed with, you credit. But you cannot have both. But if you have both, that is what you do, so that the balancing figure is cash received. That is the money you received. The next area to look at is all about cash paid to suppliers. So for the cash paid to suppliers, the first thing you determine is credit purchases. So we determine this by saying cost of sales is equals to opening stock plus purchases minus closing stock. You make purchases the subject of the formula. So it will be cost of sales minus opening stock plus closing stock. And so once you have determined this, the second thing to do is to prepare trade payables account. So you prepare that one, trade payables account. Prepare trade payables account. So trade payable account. So the trade payables account, so the balance brought down. Then we have your balance carried down. So what can increase these accounts? So what can increase the creditors balances? The credit purchases, which we have determined. This one. Then if there is creditors balances, on a subsidiary acquired what can reduce the creditors balances? Discount received and we have creditors balances on a subsidiary disposed so that the balancing figure is what you paid, cash paid. That is what we were looking for. So for the last one, that is cash paid to employees, you consider your operating expenses, the admin and the distribution expenses. So those are the one you consider. And maybe adjust with non-cash flow items like impairment. They are adjusted against those operating activities. So for us to address this topic well, you will be able to find a question you tackle so that you will be able to understand how it's done. So for my case, find me on the other side when I will be tackling the questions. So we would like to do a question of November 2016. November 2016. November 2016. The November 2016 question 2. So this is the question for the day. That is for this session. So it's a question of Kichiko group. There's another one we'll do for Kengo group, Mawing, or I will share answers for that because once you understand down 3 questions, the others you can be able to do. So I mean, if you are capable of understanding yesterday's question, today's question, maybe an additional question I will add here, that one of 2018, then I will be able to share answers maybe for a question for this Baraza Limited, Mawingu, Kengo, Rasit in question. So if you do all of that, I think the 20 marks for the December 2022, you will be able to get all of them. So they are saying that the following are the group income statements and group statement of financial position of Kichiko Group of Companies for the financial year ended 31st October 2016. So we have Kichiko Group, that is income statement for the year ended 31st October 2016. So we have the income statement. We have the income statement. We have this
question again, teacher.
November 2016, question 2. November 20.
Thank you.
So you have an income statement, Jerry, and you have a statement of financial position there for 2 consecutive years. Then you are provided with an additional information. An item of plant with an original cost of 850 and with a net book value of 450 was sold for 320 during the year 31st October 2016. So we have to check if they made a gain or a loss. That additional information, number 1, when they did that disposal. Note 2. Note 2. There was also an investment which was sold for 300 during the year ended 31st October 2016. So also we need to check what they realized there. You are told they realized the 300. If they make a gain or a loss, you have to compare with the balance of that investment as at 2015 because the 300 is as at 2016. So the 2015 balance for the investment, you will check it on the non-current assets because an investment is a non-current asset. Then note 3, during the year ended 31st October 2016, Kichiko Limited acquired. So this is an acquisition is done. So a subsidiary which has been acquired. That is why they say that they acquired. Kichiko acquired Sahani, 80% of the share capital of Sahani. The assets of Sahani were as follows as at the date of acquisition. So you have the net assets there. Then there's an analysis which is provided there of property, plant, and equipment. So whereby they are saying that the following information relates to property, plant, and equipment. We have the cost, accumulated depreciation, net book value. The cost of property, plant, and equipment of Sahani on the date of acquisition was 1,000, and the accumulated depreciation on the property, plant, and equipment was 400 million. During the year ended 31st October 2016, there was a revaluation gain of 100 million attributable to the holding company's property, plant, and equipment. The total purchase consideration of S was 450, paid by issuing 100 million worth of ordinary shares at par. The balance was paid in cash. The balance was paid in cash. Number 6, depreciation and loss on sale of plant are included in the cost of sales. Required group statement of cash flow in conformity with I7 for the year 31st October 2016. Using direct method, they are very specific, but I will do using both. I will go against the examiner's wish. So they were saying that we use direct. On my case, I will use both for me to address the aspect of indirect and direct so that you will be aware how we can apply both and you arrive at the same answers. So now time management. So if it was in an exam, remember that you move with speed. But here now we are not in an exam, we are just studying. So, but also we can move with speed because for now I think you have a know-how what is required in cash. So we do using indirect and we do direct. And the only part which will differ is the operating. So we have November 2016, question 2. November 2016, question 2. So it's a question of Kichiko group. It's a question of Kichiko group. So they are saying, this is question 2, Kichiko group. Kichiko group. So we are doing group statement of cash flow. Group statement of cash flow. So that is for the year. The year was ending on 31st October 2016. So I'm starting with indirect method, then I will do direct. And if they were very specific, I will start with indirect then. So I will start with indirect, then I use direct. So I will start with indirect. So operating activities. So we start from profit before tax. So the profit before taxes from the income statement, 3,200. Then I said we make adjustments. So adjustments for. So I mentioned yesterday that we make adjustments for what?
Depreciation.
So we make adjustments for depreciation. So you just mentioned depreciation. These are non-operating items. Depreciation, impairment, amortization, loss on disposal, and we have a gain on disposal. So you go then now to the additional information you check. If you are given depreciation, are we provided with depreciation in the additional information? Are we provided with depreciation for the year?
Yes.
So in which additional information are you provided with?
Is it 4?
Sorry?
Additional information number 4.
Is that depreciation for the year or accumulated depreciation? So these are additional information number 4. This one is accumulated depreciation. So when you are provided with accumulated depreciation, it means that you have to do a depreciation account to determine that depreciation for the year, for the current year. Remember, this is accumulated for the number of years the asset has been in existence. So what we do, we have to do a depreciation account. So working number 1, we have to do a depreciation account. We have to do a depreciation account. So for you to do a depreciation account, it goes hand in hand with disposal account. And at the same time, we do a PP analysis. So these 3 goes hand in hand. So checking in my question here, disposal, we can even start with disposal account. An asset which was disposed, it has a cost, accumulated depreciation, and the sales proceeds. Then depreciation, we talk about balance brought down here, balance carried down. So for the disposal, because there's information which I would borrow from the disposal account for me to do the depreciation account. So note 1, there was a plant with an original cost of 850. It was disposed at what? It was having a net book value of 450. It was sold for 320. Proceeds is 320. Meaning that accumulated depreciation will be, remember we say cost minus accumulated depreciation is equals to net book value. We have a cost of 850. We don't have accumulated depreciation, but we have a net book value of 450. So this X, which represents accumulated depreciation, will be, if you take 850 minus 450 equals to X. So this one is 400. So it was disposed at a loss of, because if the balancing figure could have been on the debit side, that could be a gain. But now it's a loss. And we have 850. And we have 850. So 720 minus 850. 850 minus 720. 130. So depreciation. The accumulated depreciation balance. The accumulated depreciation balance brought down 29. Balance carried down 34. I think you are seeing where I'm picking the balance brought down. The one for 2015, sorry, is the balance brought down. 2016 is the balance carried down. So 2934. Then here we have an asset which was disposed. So it was having accumulated depreciation of 400. So you debit here, disposal, 400. You debit disposal. Is there anything which can affect the depreciation again? Any disposal you can see in that additional information? Additional information number 3. Remember that during the year 31st October 2016, there was an asset which was done what? Not an asset. There was, yes, it's a subsidiary which can be an asset. It was acquired. So when this subsidiary was acquired, it was having net assets, including even property, plant, and equipment. So the property, plant, and equipment, we have that of 600. So remember that those net assets of that subsidiary, the net assets, like now the PPE which is there, property, plant, and equipment, is at net book value. Obvious, this is an extract from the books of that relevant subsidiary. That is what has been provided here in note 3. So meaning that that PPE of 600 is at net book value for the PPE, property, plant, and equipment. But if you can go ahead and read note 4, the paragraph which is down there in note 4, they were saying that the cost of property, plant, and equipment of Sahani on the date of acquisition was 1,000. Remember, Sahani was the subsidiary which was acquired. We know the net book value is this. Then you are told the cost is 1,000, meaning that the accumulated depreciation was 400. They weren't even to mention that 400, and they said accumulated depreciation on property, plant, and equipment was 400. How do we record that one here? Do we credit or debit? Remember that we have to credit here Sahani the depreciation of that subsidiary which was acquired of 400. We increase this account. So meaning that the depreciation for the year will be, that is what I was looking for, 2,900 plus 400, 33. So this is 38. So
Teacher,
yes, depreciation here will be 500. Yes, ask your question.
On this note 4, where it reads the cost of property, plant, and equipment of Sahani Limited on the date of acquisition was 1,000, and accumulated depreciation on the property, plant, and equipment was 400. So which 400 have we? The one for the disposal is the one. Okay, which 400? The one for the disposal or the one for Sahani? Yeah, I want those two 400s are confusing me.
Which two 400? Remember, this 400 is this 400. This is different. This is an asset which was disposed. One I've debited here is what I've debited here. This 400 is the one for Sahani, a subsidiary which was acquired.
Okay. Yeah.
In your asset, you go disposed. Not one, I think. Credit here, debit.
Yeah.
Then this one is for the subsidiary which was acquired. It's property, plant, and was having accumulated.
Thank you.
So meaning that we have 500 here. So depreciation they can give you direct or they do this. Either. It's not a matter that they give you depreciation for the year direct, like the question we did yesterday. They can do this. They can give you the aspect of disposals and accumulated depreciation. So what you are supposed to do is all about you do your accounts. So I can go ahead and do PP analysis, even if the balancing figure I will get here will not be important at this level. But we can do it because the results from PP analysis goes to investing. Either we find that they acquired an asset or they disposed it. That is the result. You remember that? You remember what we did yesterday? Yeah? Mmesahau. Anyway, I assume that you remember. So the balance brought down from this question for PPE. I want to use the net book value approach, NBV approach. So meaning that the balance brought down I will start with here is the NBV, which is 3050. Then now I will check from additional information number 1 to the last, anything affecting property, plant, and equipment. You understand what is property, plant, and equipment? These are just fixed assets aggregated. So note 1 is that plant which was disposed. Plant disposed. Its carrying amount was, which is the same as NBV. So you are told NBV is 450, net book value. We deduct that. Note 2, there is other investment, but other investment can never be attributed to property, plant, and equipment in any manner. It's an intangible asset. Note 3, there is Sahani, which was having property, plant, and equipment. The PPE. Sahani, remember when I would be talking about Sahani. Sahani is an acquired subsidiary. So Sahani acquired subsidiary. So this one we add the 600. It's an acquisition. So is there anything to mention in note 4? Because for note 4 is all about the interpretation they are giving us for that same property, plant, and equipment, plus the one for Sahani. They are telling us that in that paragraph in note 4, that there was a cost of the same property of 1,000. Accumulated depreciation was 400. That is why we arrived at 600. So the only thing which would affect us here in that paragraph under note 4 is the last sentence where they say during the year ended 31st October 2016, there was a revaluation gain. So revaluation gain. So PPE revalued. Then note 5 is just total purchase consideration of Sahani, which they call S, so that they convince our students to think that S is another company. No, S is just Sahani. We know that S is the one which was acquired. Sahani is the one which was acquired. There's no way that one can affect property, plant, and equipment. The note 6, they are very specific that the depreciation and loss on sale of plant was included in the cost of sales from your published accounts, financial reporting. When you are trying to classify your expenses based on various functional heads, you know how you classify depreciation. Huh? Anyway, they are very specific that the depreciation and loss on sale of plants are included in the cost of sales. So far, what do you have? So what I have not deducted here is only depreciation, which we computed, this one. So the 500. Up to that point, what do we have? So 3050 minus 450 plus 600 plus 100 minus 500. This is 28. Then the balance carry down. The net book value of property, plant, and equipment. 2016, 38. So meaning that they did an acquisition of an asset on which they did a payment of 1,000. This one affects investing. Anyway, that one would be taken to investing activities. impairment, you have to compute. What do we have here? From these workings we did, there's a loss of 130. It's a loss of 130. There's a loss of 130. Then for impairment, remember I said you must be provided with what? For you to do impairment, you must be provided with what? Goodwill. Under non-current assets, do we have goodwill? Under the non-current assets, do we have goodwill? What we have is intangible assets. They have said intangible assets. They said including what? Including goodwill. Do we have to compute now impairment on this line? I mentioned about this one yesterday. Anyway, there's no impairment automatically. Because when they say intangible assets, they are not specific. Our goodwill is at what value? Because it's included here. So what I need to compute is all about either acquisition or a disposal of this intangible. Acquisition or a disposal of this intangible asset. But before I do that, I need to know the goodwill of Sahani, which is an acquired what? An acquired subsidiary. So we say purchase consideration. When they purchased Sahani, they paid how much? The purchase consideration was 450. That is not 5. Even if they paid some amount with shares, the total purchase consideration was 450. We just what? Share of net asset. So you know that this is partial method I'm using because you cannot see fair value of NCI in that equation. We are just going for the partial. Since the NCI is not stated at its fair value. So the net assets, so we just use the total value of the net assets. According to note 3, the total value of those assets adds up to 500. Adds up to 500. So 80%, 20% of the 500. This is, sorry, here we don't have to share. I've mentioned full method. Now even I'm going ahead to use full. This is partial, so we just use 80%. So 80% of 500 is 400. So my goodwill will be 50 of sign. So after getting 50, the 50, we have to do the analysis now of the intangible. Analysis of the intangible assets. So the balance brought down. The balance brought down 2,000. You add this of the goodwill of Sun because that goodwill is included here. Sun is a subsidiary which was acquired. Sun is a subsidiary which was acquired. So we have 2050. Balance carry down. You skip one line and you say balance carry down. The balance carry down for the intangible assets is 2,500 from the non-current asset. So there's an increase. So meaning that they did an acquisition of intangible assets of 450. Again, this one affects what? Investing activity. There is no amortization. There is no impairment. Because they never gave us the specific intangible assets. Like now, for us to do the analysis of goodwill, they have to mention goodwill. If it's amortization, they have to mention specifically a certain intangible, like patents, trademarks. That is it. So gain on disposal. There was another asset, there was an intangible asset which was disposed. According to note 2, there's that investment which was disposed. There's this investment which was disposed. They gave us the disposal value as at 2016. That is note 2. Other investment was sold for 300 during the year ended 31st October 2016. So as at the end of 2015, it was stated at what value? You can see here, we have investment, other investments. You can see in 2016 is dash. That is why we mentioned there 300. As at 2015, it was 250. So by the end of 2015, the other investment was at 250. By the end of 2016, it has been disposed. It has been disposed at 300. So they made a gain of 50. Gain on disposal of investment, of other investments, 50. So this one you deduct. You know, expenses, we add back, incomes we deduct. Since we are adjusting what? The profit before tax. Then, after this, we embark on the income statement. We go to the profit before tax. Go to the profit before tax. I mentioned other than what? Other than revenue, cost of sales.
Revenue, cost of sales, distribution, and admin.
Another item which is above that profit before tax, we adjust. Investment income, share of profit. That is share of associate company profit and finance cost. You have to adjust against that profit before tax. They are considered to be non-operating items. So we have the investment income, investment income 250. So this one you deduct. Then share of associate company profit, share of associate company profit, company's profit. That is 200. Finance cost. So the finance cost is 750. So it was deducted and we add. So up to that point, we say cash flow before changes in what? In working capital. Before the changes in working capital. So 3,200, we say 3,200 minus plus, not minus, plus 500 plus 130 minus 50 minus 250 minus 200 plus 750. So I get here 4,080 shillings. Then we go direct to the changes in working capital. Changes in working capital. So for the changes in working capital, mention shillings. So inventory. So in inventory, so I have to do an analysis to check if there's increase or decrease. Inventory 2015. Remember that For working capital, we'll be checking inventory, receivable, prepayments, payables, and maybe accruals. But not accruals for interest, accruals for other items, not interest. Interest affects finance cost. So for inventory, the balance as at the start is 1020. So there was a sahani which was acquired. Since it was acquired, it came with an inventory of 400. That is not what? Not the 3. So you have to add the one for sahani. Then you compare with the balance carried down. So the balance carried down for inventory is 15. So this is an increase or a decrease? Increase by 80. So we say increase because this is 1420 to 15. So when your assets increases, it means that there is cash out. We go to receivable. You do the same. So receivables. That 150 plus the one for Sahani. When Sahani was acquired according to note 3, it came with a receivable of 300. But now the balance at the end is the receivable at the end, 39. Again, there's an increase by 450. That one again you deduct, increase in the receivable, increase in your debtors. You have given them money. So there's money out, they have increased. Under current assets, there is short-term investment and cash balance. That is cash and cash equivalent items. You go to current liabilities, there's payable. So you check increase or decrease. So payables. So for the payables, 1990 plus Sahani. The payable for Sahani is 400. Balance at the end is 2270. Increase, decrease. 1990. If you don't have a question, make sure you are muted. Because I can hear someone is unmuted. So this is 2390 to 22. So this is a decrease. A decrease in payables. You deduct. When your liability decreases, it means that you have paid money. That is why they decrease. So up to this point, we have cash generated from operations. Cash generated from operations. So 4080 minus 80 minus 450 minus 120. So this is 3430. And here we have to raise tax paid. Once I will be able to determine this, I am done with operating activities. So we say cash flow from operating activities. Cash flow from operating activities. So I can decide to do a working here, but on your scenario, remember that you have to keep an enough space before you do this working. Faith, how are you? Faith? Faith. When I say hi, you mute. So working.
I'm fine, mwalimu.
Oh, that is good. So tax. So taxation. So we consider deferred tax. So I can say DT instead of writing a lot of information. You know, it's deferred tax and current tax. So So balance brought down. Is there a deferred? You check on your non-current liability. There's nothing like deferred here. So I use only current. Because under non-current liability, what I can see is only loans. That is what I can see. So current liabilities, we have current tax as at the start, 980 or what? 980 or it's 11. We have 1100. And obviously, you have to consider the income tax from P&L. Income statement, what they paid during the year. From the income statement, 14. And obviously, consider the subsidiary which was acquired. Subsidiary acquired. So now here we add the current tax. They said tax. So tax for that is not 3. There's tax for 50. So this is just 25, 50. Balance carry down. You skip one line, you say balance carry down. The balance carry down, 12. So meaning that they were supposed to pay this, but at the end they are told to pay 12. So there's a reduction of 1350. Tax paid. 1350. So 3430 minus answer. So this is 28. So that is A. We are done with operating. Any questions so far? So good. Michael, are we not supposed to take the balance as brought down at cost? It matters. You can use the cost analysis, but for me, I went with the net book value analysis. So when you use cost, make sure that the other items you will be considering, they are at cost. You can use cost, but the other items you make sure they are at. If you are using net book value approach, the other items you are incorporating in that PP analysis, you make sure their figures are at net book value. There's no impact on that. Oh, yeah. We talk about investing activities. We have done around all of the workings required, by the way, for this. So there's a disposal which was done, cash received. In note 1, before I go to the workings, in note 1, there was cash done what? Received. An item of with an original cost of 850 and with a net book value of 450 was sold for 320. So cash received on disposal of plant 320. So cash received on disposal of other investments, that is note 2, 300. So from PP analysis, we got which figure? So cash paid to acquire assets. We did a working under PP. It was 1,000. Then there was again cash paid to acquire other intangible assets. There's a working we did for intangible. So the figure was, when I did intangible, then I did analysis on that. The balancing figure was
450.
450.
was acquisition. And here you record investment income. Is this one here. You add that one. Then remember, sign was acquired, so cash paid. Cash paid to acquire subsidiary. Cash paid to acquire subsidiary. Net of cash acquired. It came with cash, or it came with a liability. If it came with cash, the better. Even if liability, we'll check on how to do that. So when they did what? When they acquired Sun, they paid note 5. That is why they mentioned the total purchase consideration of S was 450. But I need cash only. So they said by issuing 100 million worth of ordinary shares, the balance was paid in cash. So meaning that you have to net the 450, which was in terms of shares. But when they did what? When they acquired these, Sahani, did it came with any cash? Because if it came with any cash, we minus. Because if it came with any cash, that cash it came with will reduce what we paid. Did it came with any cash? So we check in the net assets in on the 3. It came with a bank balance, which is negative, meaning that is an liability, not a positive balance. Meaning that, am I supposed to minus or add? That one will be added. So this one will remain to be 450. And we are done with that. So cash from investing activities. Cash flow from investing activity. 320 plus 300 minus 1,000 minus 450 plus 250 minus 450. What are you getting? What are you getting, guys? Give me the answer. Give me your answers.
I have a question. We don't have dividend received.
Well, that is what we have not recorded. So we need to include. So that is good for that correction. So let's include that dividend. It was received from who? The investment was done to who? The investment in the non-current asset, was it done to the associate or the inventor?
Associate.
And so that investment was done to the associates. Or you can say dividend received. Dividend received from associates. So I can do direct here. The initial investment was the investment in associate in that non-current asset. The investment was, that is according to 2015. It was
500.
500. What am I supposed to add here? What they received as income from the associate. So if you go to your income statement, you will see something there calling share of associate company profit under other incomes of 200. So meaning that their investment, the investment of their parent in associates increased it to 700. But at the end of the year, the investment is shown as 650. Why did it reduce? They received the dividends of it. That is good for the correction. So cash flow from investing activities. So this one is supposed to be 980, an outflow. And finally, we have financing activities. So under financing, we start with mostly we focus on equity and liabilities. So ordinary share capital, share premium, we combine them, we do analysis to determine if there was an acquisition, if there was an issue of shares or a redemption of shares. So we do a working, we can do some workings here, side clear. So the workings for ordinary share capital, there is no share premium. So we just consider ordinary share capital. Balance brought down. Ordinary share capital balance brought down 15. What can I add here? There was issue of shares. Issue of shares as purchase consideration. When they acquired Sahani, they gave out 100 through shares. The one we deducted here, that one was through shares. Then if there was a bonus issue or right issue, remember we could have recorded there. So we have 16. Do we have a bonus? Don't think. So balance carried out. Balance carried down is 2000. Am I correct to say that it's 2000?
Correct, 2000.
But there was share premium. So you could have told me that there was share premium. I can see this as share premium. Meaning that we have to combine. So there's a share premium 15 plus what? There's a share premium of 15 and equity. Are you not seeing that? So meaning that even this one is 2000 plus the share premium is 16. It is a share premium. Under the equity, there is share premium and ordinary share capital. So you combine them. So this is 36. This is 36, meaning that this is 31. So it increased. They realized an extra 500 because they did what? They issued shares. So cash received on issue of shares. $500. Even if there is a reserve, but there is a reserve, you can realize that the reserve as at the start is 910. At the end is 1010. But if you go to the additional information, number 4, the paragraph which is down there in number 4, there was a revaluation of 100. So if I take my 910 plus 100, it would be 1010. That is 1010 shillings, which is the same as the balance carried out. And we don't use revaluation. It's only that they were trying to. I'm trying to confirm that there's nothing there to be recorded here. For the retained profit, we do analysis again. The retained profit will assist us to get what? Dividend paid. Dividend paid by who? Parent. So balance brought down. Retained profit 12. Profit attributable to parent. The profit attributable to parent from income statement. Parent is also called holding.
1650.
That is 1650.
1650.
If you add the two, what do you have? If you add, what do you have? What do you have there? What is it? 0582. Balance carried out is the retained profit, Balance carried out as at 2016. 1740. The dividends paid will be. I have to use the calculator again. Cannot give me the answers. So 2850.
1110.
That is
1110.
1110. 1110. So dividend paid by parent. 1110. And next, we have to check dividends paid to NCI. That is why next item after retained profit. The next item after retained profit is you can see under equity. Yeah, I am done with ordinary share capital. I've talked about the revaluation reserve. Retained profit, we are done with it. After retained profit, you can see it's a share premium, which we are done with. We combined with capital. The next one is non-controlling interest. The non-controlling interest, that is what I do here next. The non-controlling interest. So non-controlling interest, you talk about balance brought down. The balance brought down is 300. What am I supposed to add here? Profit attributable to NCI. Profit attributable to NCI, that is from the income statement, the last item there.
150.
150. Then we consider Sahani, the NCI on the net assets. On the net assets of Sahani. Sahani is the subsidiary which was acquired. Remember that? So the value of the net assets was 500 according to note 3. The total of those assets. The totals of those assets times what? The NCI was. So the subsidiary Sahani was
20%.
20.
20, that is 100. So I could have considered the goodwill, and that is NCI goodwill. NCI goodwill on Sahani. If we use the full method, but we never use the full method. We use the partial. So we could have been having this if we use the full method. Up to this point, we have what? 0, 5, 4, 5, 550. The balance carried out.
$500.
500. So there is a dividend paid of 50. There we have 50. After this, we go to the liabilities. We have loan. Did they acquire loan or they paid? As at the start, it was a 500. Under non-current liability, it was 500. Then suddenly it was having a loan of
250.
250. So 500 plus 250, that is 750. At the end is 17. So they did acquisition. Acquisition of loan. Because if I take 500 plus 250 for Sani minus 17, it's what? 950 or what?
In 50.
That one we add. It's money in. Then after that, we go to liabilities. Is there any accrued interest there? No. What do we have to record as interest paid? To consider
Finance cost.
your finance cost. 750 from the income statement. That is interest paid. So cash flow from financing activities. Cash flow from financing activities. Whoever who has done the total.
460.
It's
460.
positive.
Negative.
460. Negative.
And net cash flow. If you take your A plus B plus C, $20.80 minus $980 minus 460.
2640.
It's 40.
Add cash and cash equivalent. Balance brought down so that we have cash and cash equivalent balance carried down. So here, if I add this and get this, so we have cash and cash equivalent, which I can do a working. So cash and cash equivalent. So 2016, 2015. So we consider the cash and cash equivalent items. You go to the current assets, you pick these two items there representing cash and cash equivalent, which is short-term investments and what? We have short-term investment and cash balance. For short-term investments, it's all about 500 and dash, 20 and 10. Then bank overdraft. You go to the current liabilities, you pick your bank overdraft. So the bank overdraft under current liabilities, 850 and 980. Bank overdraft you deduct. So meaning that this is negative 970. And what about 2016? 520 minus 850. Return to negative. So if I put this here as balance brought down, it will be reduced by a positive of 642. Maybe if you minus 640 from 970. It will remain to be a negative of 330. Yeah?
30.
So we have reconciled the opening balance, the opening cash balance, and the closing cash balance. It's a confirmation. Have you ever realized that advanced financial reporting is easier than financial reporting? Some of you guys who are my students in financial reporting, I expect you to pass this paper because this is easier than financial reporting. Why it is easier? Because it has few topics to concentrate on. Financial reporting, you have more than 15 areas. Even if yes, also we know some few topics to be tested, but financial reporting has a lot of work to be done. This one, once you know cash flow, group, EPS, reconstruction, uko sawa kufanya exam no. So so the way, anyway, before even I do direct, there's a student who will open we call it a syllabus today and look at it. It will look to be fun. What I've mentioned is what you need to know if you want to pass. But now if you want to do research and write a research.
Mention again, teacher.
See, you know the main topic.
Mention again.
You know the main topic is group, cash flows, you know that. I've been saying this from time to time. EPS and the reconstruction. These are the main topics for you to make. So kwa hizi topics umeona question namba 3 sikikosa kwa mtihani in any paper of financial reporting. This contains more than 6. That is why I did these topics towards the end when at least none of you were around. And I'm sure most of you have gone through these topics. You have attended sessions for this, other than the guys maybe 2 or 3 guys who joined it other day. Most of you, 80% of you guys, you have done this. And be careful on insurance this time. Mostly, nowadays they interchange these two. Previously, they were testing both of them. Nowadays, they interchange EPS reconstruction, EPS. But for you to be on a safer side, these are the topics you are supposed to be conversant. Yeah. So, direct method. So I want to do only operating activity. So we start from cash received from customers, cash paid to who? To suppliers. And we have cash paid to employees. So that we get cash generated from what? Cash generated from operations. Then we raise tax paid. Once we raise the tax paid, we get the cash from where? from operating activities. So here we talk about cash received from customers. So for you to get cash received from customers, working one, we do what? Which account are we supposed to do here? Trade,
Receivables account.
balance brought down, balance carried down. So the balance brought down, you check the one for 2015 under current assets, trade receivables 2015. At 150, and this is 30 what? 39. What can increase this account? Sales, which was done on credit. If you go to your income statement,
Sales.
there's that revenue, they say, even they were very specific that from credit sales. So even if they never mentioned that, we assume it was on credit. Here there has no one who will use a credit. We assume it's on credit. So that was the revenue. 25, 530. Again, there was a sign which was acquired. Sign came with a receivable. According to note 3, 300.
100.
What can reduce this account? Discount allowed. Bad dates written off, but all of these we don't have. So the cash received is, that is how you get cash received. Balancing. The total is 28,980. 28,980 minus 3,900. 25,080. We do the after working. So cash paid to suppliers. For you to get the cash paid to suppliers, what you do first, you do what? Determine credit purchases. We always say that cost of sales is equals to opening stock plus purchases minus closing stock. So we need these purchases. We make it the subject of the formula. If it remains on that side, so it will be cost of sales minus opening stock plus closing stock. Cost of sales ni ngapi? Cost of sales,
18,140.
18. They mentioned that depreciation was in note 6. They said depreciation and loss on sale of plant, they are included in the cost of sales. The best thing is that we did this already. Depreciation. We did a depreciation account. You remember that when I was doing the indirect method. Depreciation was
500.
I deduct loss on disposal, because they say depreciation and loss on disposal is inside here. Even if they never mentioned that, you have to know that. It's only that this examiner loss from the disposal.
130.
And that
Yeah, that is good. Opening stock, inventory 2015, then 20. Add the one for Sani. When Sani was acquired according to number 3, came with an inventory of 400. And closing stock 2016, inventory 2016. 17,590. So now we open what? Trade payables account. So after determining credit purchases, the second thing you do, trade payables account. So balance brought down. We have balance carried down. So 1990, 2270. In credit purchases, that is what can increase here. This one, 17,590. Then, other than credit purchases, what can increase this one? Sahani, the payables of Sahani. When Sahani was acquired, according to note 3, it came with a credit balance of 400. So what can reduce here? Discount what? If you received a discount from your creditors, maybe you received a discount, obvious, what you are supposed to pay them will reduce if they gave you a discount. So cash paid, the balancing figure, 1990 plus 17,590 plus 400, 19 minus 2270. This is 17,710. That is what I will deduct here. Then finally, we consider cash paid to employees. I think you are okay up to this point. What we have done We are okay with it. So far, so good. So the
Cash paid to suppliers should be negative.
this one a deduction. You raise. Not that it's a negative, but it's a deduction. So cash paid to employees. Consider your operating expenses, because that is where those expenses you paid employees are, those salaries you paid employees are included. So we have admin and we have distribution. So admin and distribution is 2640 and we have 1250. 098 3890. So what am I supposed to test here? The only item which has not been adjusted out of even when I was doing my indirect method, when I was adjusting my profit before tax, there was a depreciation, there was a loss on disposal, there was gain. So the only thing here I will raise, which has not been adjusted anywhere, is all about the non-cash flow expense. Non-cash flow expense, which is all about an non-cash flow expense right now. If there was impairment, but it was not there, I could have deducted. We deduct it here. Then another thing which has not been adjusted here is all about, there was a gain which was made, by the way, when they disposed that investment. So the gain on investment, you add it back to your operating expenses. That's to affect these operating expenses. Gain on investment. Remember, it was initially stated at 250. The investment was sold at 300. So we have a gain of 50. So this one will give us a balance of 0, 4, 9, 39, 40. 39, 40 is what I will record there. If I deduct 25,080 minus 17,710 minus 39,40, I will get 34,30. Our tax was 1350 from the indirect. We did that one here. I don't have to repeat. You can see we are arriving at the same answer. Hii ndio tulipata tukifanya indirect. No matter the method used, they have to be the same at the end. So if you were to continue with investing and financing now, they will remain to be the same as what? The one we did for indirect method. That is all for this question. So let's look at a question of November 2017, question 3. So they are saying that the following are the group statement of comprehensive income and the group statement of financial position of the group, of the Manana group of companies for the financial year ended at 1st October 2016, at 1st October 2017. So you will be given an income statement there. So you can see the income statement is for 31st October 2017. Then statement of financial position is 2017-2016. 31st October 2017-2016. Additional information. During the year ended at 1st October 2017, depreciation of 240 was charged in relation to property, plants, and equipment. An item of property with a carrying value of 885 was disposed during the year ended at 1st October 2017 for 715 cash. The loss is part of the cost of sales. Number one is all about depreciation. Number two, they are doing a disposal, so, of which they made a loss. Then now number three is what is mentioned in this question. In any advanced financial reporting question, the cash flow, for it to be advanced, it must have the aspect of obvious. It would have the aspect of dispose of subsidiary or a subsidiary which is acquired. So that is why in number three they are saying that on 1st of August 2017, the group disposed an 80% on the subsidiary for 1170 in cash. The subsidiary had the following net assets as at the date of disposal. So they disposed a subsidiary which was initially acquired. So they have provided the information when it was acquired. You can see here they say the subsidiary had been acquired on 1st November 2012 for a cash payment of 660, when its net assets had a fair value of 675, and the non-controlling interest had a fair value of 150. Additional property, that is number four. Additional property, plant, and equipment was acquired by way of lease, amounting to 900 million during the year ended 1st October 2017. Number five, dividends paid by holding company. Holding, remember that it's the same as parent. So it's all about 120. Number six, land was revalued upwards by the holding company by 60 million during the year ended 1st October 20. We need to do group statement of cash flow according to International Accounting Standard 7. They are not specific which method to use. And in any exam, when the examiner is not specific, then which method, always go for indirect. You will score a lot of marks under operating even before you go to finance. And it's easier indirect. But I will do another question whereby I will address the aspect of direct. So for now, let's use indirect method to do this question. So what you can see from these two statements is that you have an year which is ending 1st October 2017. So you are provided with an income statement for the year 31st October 2017. Then you are provided with statement of financial position for the 2017-2016. So what they mean is that for 2016, that is just an opening balance for 2016. Because you have been provided with 1st October 2017, 1st October 2016. So 31st October 2017, 1st October 2016. So that is 1st October 2017, 1st October 2016. So meaning that the balances for 2016, they will be opening for 2017 because 2017 will start on 5 November 2016. So yes, these balances, they are opening here. So Maneno group. So we have the Maneno group, group statement of cash flow. So that is for the year. For the year ended 31st October 2017. We start from operating activities. So I've said I'm using indirect method. So we start from operating activities. So from operating activities, we take the profit before tax. From the income statement, are you seeing the profit before tax? I assume that you have the question. The profit before tax is 699. Then we adjust this profit. We say adjustment. So I say some of the adjustments to be made here. Even before you write them, even before you check if they are present or not. Depreciation. You talk about impairment. You talk about amortization. Loss on disposal. These are non-operating items. They are not attributed directly to the business in terms of generation of income, but they are expenses to the company. Non-operating items. So loss on disposal, gain on disposal. I have mentioned these 5 even before, checking if they are present or not. Now I will go back to the question and check if they are present or not. Note 1 is depreciation of. That is when I say note 1, I mean additional information number 1. Depreciation of 240. This is depreciation. Then impairment. For you to go ahead and check for impairment, you go to your non-current asset. Is there goodwill there? Under the non-current assets. You are remaining.
Yes.
So 2017, the goodwill is
510.
255. The goodwill is 255. Here it's 2016, 390. This is 2017, 2016. If I was to conclude that there's impairment, I could have concluded, but you cannot conclude at this point. You have to go to the additional information and consider that subsidiary which was disposed. As at the time it was acquired, its goodwill is. So since it was disposed during the year, we have to deduct that goodwill it was disposed. But goodwill we compute as at acquisition. So according to the question of ours, which method would I use? Because that subsidiary which was disposed, that is according to additional information number 3. There's a sentence there which I have marked blue. They said the subsidiary had been acquired on 1st November 20. Cash payment 660. Net assets had a fair value of 675. The non-controlling interest had a fair value of 150. NCI. So meaning that we do what? We use full method when doing the goodwill of this subsidiary which was, as at the time it was acquired, you have been provided with the fair value of the non-controlling interest. So we use full method. So purchase consideration So it was a true cash payment of 660. So for us to have a full method, remember that we consider fair value of NCI, which has been provided, which is 150. Whereas the share of net assets acquired. So it was an 80% disposed subsidiary. So 80% to the parent, 20% to the NCI of the net assets. That is 675. Answers to be deducted here. Use your calculators well. You don't have to waste a lot of time here. These are the things, we have been doing goodwill. We have been doing consolidation from time to time. We did around 7 questions. I'm not wrong. Plus there are 6 questions, which I said you want, from what I did online. So 660 minus 540, 120, 150 minus 135. So we have goodwill. The total goodwill is 135. So under cash flow, what we are doing is analysis. So now I want to analyze and determine if there is impairment or not. So I will consider my goodwill at the start, 2016. So that is a balance drawdown. I will deduct this one. This one was a disposal. When this subsidiary was disposed, it was disposed with this goodwill. So here I will remain with 255. I will skip one line here and write balance carried down. The balance carried down is 255. There is no reduction, no impairment. 0. If it could have reduced from 255 to that, I could have said there is impairment. That is how you analyze. For you to go ahead and analyze and check if there is the aspect of impairment, you must have goodwill. If you are given intangible assets, including goodwill, you cannot determine that. What you will go ahead and determine after your analysis is either acquisition of that intangible assets or disposal. And that one goes to investing. I will do another question to address that. For amortization, again, you go to your non-current assets. Check if there is another intangible assets like patents, trademark, which can be amortized. Those are some of the items which are amortized. But if you go to those non-current assets, I can't see some of that kind. Nothing like amortization. Loss on disposal. Additional information number 2. There was an asset which was done what? Disposed. Property, to be more specific. Its carrying amount was 885. It was disposed for 750. So they made a loss of 885 minus 750. 135. There's no another asset which was disposed. There's no gain. So maybe the gain which can be there is the one which is given in the income statement. Was there any gain in the income statement? Yes. When they dispose the subsidiary. So for the additional information, we don't have any gain. But the only gain I can consider is when I go to the income statement. But for now, this is how you start. Once you are done with this analysis, you embark on your income statement. Go direct to that point of profit before tax. You go to this part of the profit before tax. So that is what I was adjusting. This one. So you go back once. Other than revenue, cost of sales, distribution and admin. Those are some of the operating activities. Other than the four, the one I have marked, any other item, any other variable above that profit before tax must be adjusted against that profit. That is gain on sale of subsidiary, share of profit after tax in associate, finance cost. So gain on disposal. So stock sale of subsidiary. So that is 120. It was added with gap. We talk about share of profit after tax in associate. 144. You deduct. Finance cost. Or 50. You add. So up to this point, you say cash flow before changes in working capital. And say WC, working capital. 699 plus 240 plus 135 minus 120 minus 144 plus 450. 1260. And we mentioned about the changes in working capital. So the changes in working capital, we consider current assets, that is inventory, receivables, and maybe prepayments, increase or decrease. So we just leave a space here and say in inventory. So that once I do analysis and determine is an increase or decrease, I would just fix the increase or decrease there in my space, which I have skipped. If I look at inventory under current assets, 2016 is 39. Never forget to incorporate the inventory on the subsidiary which was disposed. On the subsidiary which was disposed. So after considering the balance brought down, you have to come to know the three obvious. Inventory which was disposed, inventory which was there on the disposed subsidiary was 90. You minus that. The 90. Then you compare with the balance carried down. 39. So this is an increase by 900. So increase in inventory. When asset increases, it means that there's cash out. This one is deducted. And we go to receivable. In receivables. So as at 2016, that 120 minus the one in the disposed subsidiary, that is now the 3, 135. We compare with the balance carried down. 2017, receivables is at 120. Again, there's an increase by this 135. This one again you deduct. So we say increase. Then checking in that current assets, I can see financial assets at fair value, cash and bank balances. Those two items represent cash and cash equivalent. I would go direct to current liabilities and check my payable. So in payable, increase or decrease. So the payable 1785 minus the one on the disposed subsidiary, which is 540. I compare with 2017, my payable is 2955, meaning that there's an increase. So increase by which figure? 1785 minus 540 minus 2955. So 1710. So when liabilities increases, you add because there is no cash out. When they decrease is when you minus because now you have paid those liabilities. So up to this point, cash generated from operations. So 1260 minus 900 minus 135 plus 1710, 1935. And you less tax paid. We do our working. Once we determine that, we deduct. We'll be done with operating activities, cash flow from operating activities. I can do a working here, then clear. Yes. No cement. How are you?
I'm fine.
You have a question?
No.
Because I can see you are unmuted. I thought you have a question. So we can continue. So here, for tax, we consider both deferred tax and current tax. These are working. You do it on a separate page. So leave enough space for. Remember, I will continue with investing and even financing. So you make sure that these workings you do on a separate page. You have to leave enough space to cover investing and financing. So balance brought down. Is there a deferred tax and a non-current liabilities? You combine the balances brought down. Combine those balances. So what I mean is this. So this one, like this. If you are talking about the balances brought down, you combine this. Combine these balances carried down. But during the year, we have to consider some items before we talk about balance carried down. So for now, 915 plus 63. 916 plus 915 plus 63 is 978. Then consider the one in P&L. It's not about income tax expense in P&L. P&L is an income statement. Income tax, P&L. So they paid a tax off during the year. From the income statement, you can see 144. After that, consider note 3, the current tax on a disposed subsidiary. $15. So disposal you minus. So all under the areas I've been talking about the disposals. If it was acquisition of a subsidiary, you add. That is only if it's acquisition, mali tumetoa unaongeza. Sasa kama ni acquisition, you add instead of subtracting. $978 plus 144 minus 1107. You skip one line here where I will write the balance go down. You say balance carried down. Where I will write the balance in figures. And you say balance carried down. Deferred tax, current tax. Your deferred tax is then 20 plus 1020 plus 84. The balance is carried down as of 2017. Then 20 plus 84, 1104. So there's a reduction from 1107 to 1104. So tax paid is 3. That is what you deduct here. So the answer here will be 19. We continue with investing. We're done with this tax. We continue. So investing. Investing activities mostly I said we focus on what is acquired or what is disposed. So like now in note 2 there is cash received on disposal of property. Cash received on disposal of property. So the property was disposed at what? According to note 2. It was having a carrying value of 885. It was disposed for 750. Then we talk about cash paid. Cash paid to acquire. Cash paid to acquire assets. So the PPE, we have to do PPE analysis. So to find cash paid to acquire assets, you do PPE analysis. So we do our on PPE. So PPE, property, plant and equipment. If you want to study this more, go and study I-16. So anyway, it's all about what affects tangible fixed assets, the long term. So we start from balance brought down. You go to your non-current assets. We have 13,500. Then after balance brought down, go to your additional information. From additional information, I'm going to the rest. Check what affects fixed assets. Like now, note 1, we have depreciation. You minus. Note 2, there was a property disposed. It was having a carrying amount of 885. It was already, this is a carrying amount. We have to talk about carrying amount. This all we deduct. Note 3, there was PP on disposed subsidiary. So it was 2025. Note 4, there was a property acquired. That is a plant and equipment. Plant and equipment acquired. So at what value? It was at a value of 900. This one we add. Note 5 is dividends. That one doesn't affect PP. Note 6 is rand value. 60. So you add that one increases our PP. So 13,500 minus 240 minus 885 minus 2025 plus 900 plus 60. So this is it. That way, skip one line, talk about balance carried down. The balance carried down, that is according to 2017 is 18,000. So meaning that they did an acquisition here. Because the value increased. The value of the PP increased. If it was a reduction, I could have said it is possible. 11,310 minus 18. So 6690. So that is what they paid when they did an acquisition. If there was investment income, I could have recorded, but we don't have any. And we go ahead and check dividend received. So dividend received from who? It's dividend received from associate. Because if you check under your non-current assets, you have investment in associate. This is what guides us. Those dividends were received from who? So you mentioned about balance brought down, sorry. So the balance brought down for investment in associate is 420. This is balance brought down according to the non-current assets. Other than this investment with the parent made in the associate, there's an income we received from that associate during the year. And that is well recorded as an income in the P&L. In the income statement, that is, there's that share of a profit after tax. Share of profit after tax in associate. Of which value? 144. So this one increased the investment to 564. If you skip one line here, you compare with your balance carried down. The balance carried down of the investment of the parent in the associate, according to the non-current assets, is 510. Why did the investment reduce? Because the parent received what? Dividends. Dividends received. That is 54. So that's in a calculator of 54. After that, finally, under investing, remember there was a subsidiary which was disposed, meaning that we received some money, cash received on disposal of subsidiary. Net of cash disposed. So when they disposed this 80% controlled subsidiary, they received what? According to that note 3, they received,
1170.
but in that net assets, was there any cash balance which was disposed beside the other net assets? So when they disposed these subsidiary, they received these. But remember, the subsidiary is net asset. As at the date of disposal included these, for which we have cash. So this one must reduce this, what they receive. That is why we say net of cash disposed. Net of cash disposed. So it's 1170 minus 150 or 105. 150 or 105? 105. So 1170 minus 105. Then 65. So up to this point, we are done with investing. So 750 minus 6690 plus 54 plus 1065. We have 4821. So this is cash flow from investing activities. Let's finish with financing. So the first analysis I will do is that of ordinary share capital as a working and the share premium. So the main thing of doing this is to check if there is a issue of shares or redemption. So the balance has brought down, ordinary share capital, that is according to 2016, it's 45. But for share premium is dash, so 45. So if there was any issue of shares as consideration, that is, if they were purchasing a subsidiary and they paid their purchase consideration through shares, you add issue of shares as consideration. You add bonus issue or right issue, you add. So you get 45. And you skip one line here, you say balance carried down. Balance carried down is ordinary share capital is 6,000. Share premium is 900. So we have 69. This one increased. This is money they received. So they issued shares. Issue of shares. You can only receive money if you issue shares under equity. Under this analysis, when it increases, we say they issued shares. If it could have decreased, we could have said they used the money. They used the money to redeem shares. Now it increased by 24. That is money they received. So cash received on issue of shares. So after this, we go to the part of retained profit. So remember that we are under this. We are under financing. You focus on this. You focus under equity. You focus under equity and liabilities. So we have dealt with this and this. For the reserves, we don't consider that. For the retained profit, you use it to determine dividends paid by holding, which is already given. This one is given. The dividends paid by the holding is given. For the NCI, we do analysis to determine dividends paid to NCI. Bank loan, we check if they paid loan or they acquired another loan. The lease, we check if they paid a lease or they continued to stay without paying, if they continued using the asset without paying. For tax, we are done with it. Payable, we are done with it. Then what we consider now finally is interest, to check if there's interest paid. And for the others, remember that for the obligation under financing, we combine them together. Combine these. Now let's go to, for the reserves, I have said this one, I will not use it. For retained profits, I could have done an analysis to determine dividends paid by the parent, but it's already given in additional information. So I will record that dividends paid by parent, then I go direct to do the analysis of NCI to determine dividends paid to the NCI. So dividend paid by holding company, it's in the additional information. Holding company, which is parent, it's 120. And once you go to the NCI, you check dividends paid by NCI. Dividends paid to NCI. So we do the analysis for NCI. So balance go down. $525. NCI, you can see it's there. What we include here is profit attributable to NCI from the income statement. The last item in the income statement. Then we consider two items in the subsidiary which was disposed. Under those net assets, there's an NCI value. Then again, we consider the goodwill of the disposed subsidiary. So NCI on net assets of disposed subsidiary. If you go to note 3, you will see the total value of the net assets of that disposed subsidiary was 1,200. 20% of that. This is 240. And again, you consider the goodwill of disposed subsidiary. So goodwill was 15. I remember it was 120 for the parent, 15 for the NCI. We did that as at the time this disposed subsidiary was acquired. $525 plus 75 minus 240 minus 15. So this is 345. So balance, you skip one line, then you compare with balance carried down. NCI, balance carried down is 225. Meaning that again, there's a reduction by 120. So dividend paid of 120. You go to the non-current liabilities, loan, the acquired loan, because I can see it increased, acquisition of loan, because in 2016 it was 3K. We deduct the loan on the disposed subsidiary according to note 3. There's a bank loan of 600. Then we compare with balance carried down of 42. So 24 minus 42, 18. So they acquired because it increased from 24 to 42. After loan, we can do another working for obligation under finance risk. We have only 2 workings remaining. I think I can clear this. So obligation under finance risk. I want to check if they paid for the lease. So there are 2, long term and short term. We have the one under non-current liability and the one under current, short term and long term. So we combine the balances. If it's balance go down, we combine. So for the non-current liabilities, we have 135 plus what? Under current, we have that is 165. Then if you go to additional information number 4, the property which was acquired through lease. So the plant and equipment which was acquired through lease at a value of 900. Must affect the lease. So we add, we get 1065. Balance carried down. So balance carried down of the 2. Under non-current liabilities, we have 630 plus. Under current, we have 45. This is 675. So these are reduction. So they made a lease repayment. That is why it reduced. So 1065 minus 675. 1065 minus 675. 390. Lease repayment. 390. You minus. And finally, interest paid. Under the current liabilities, there is an accrued interest as at the start of the year. The accrued interest was under the current liabilities. We have an accrued interest of 27 plus the one from the income statement, the finance cost. It was 400 and something, 50. So if you add this and this, then compare as at the end we have 21. So 27 plus 450 is 477. But at the end, the interest they are supposed to pay is 21 because they paid the difference. 456 was paid. So cash flow from financing activity. So we have 2400 minus 120 minus 110 plus 1800 minus 390 minus 456. So this is 3114. So this is C. So that is C. Net cash flow. $19.32 is A, operating, minus $48.21 plus $31.14. So 19.32 minus 48.21 plus 31.14. This is 225. You will pick your cash and cash equivalent as at the starting. Add cash and cash equivalent. Balance brought down. So that you get your cash and cash equivalent. Balance carried down. So we have to do a working for cash and cash equivalent. We mentioned 2017, 2016. Under current assets, anyway, I generally mentioned the items of cash and cash. Under current assets, we have items like financial assets at fair value. In some cases, they can mention this as a short-term investment. So this is 135. This is 30. Next, we have cash and bank balances. So the cash and bank balances, 510, 390. If there was bank overdraft, you raise. But we don't have any bank overdraft. Under current liabilities, we don't have. So 30 plus 390, this is 420. 135 plus 510, 645. This one will be my balance brought down. This is carried down. So if I put this here, I add it with the cash with the net cash flow, I will get 645, which is this one here. That is how you are supposed to do cash flow statements. Very simple one.